As Alibaba stock, or BABA, was falling earlier this year, what was Ray Dalio's Bridgewater doing? They more than doubled their Alibaba stake in the third quarter 2021, and I'd actually call out that they made an even bigger bet on China, making it multiples the size of what it previously was through an emerging markets ETF bet. Let's talk about that and understand that in further detail. What is Ray Dalio investing in? What does he see? And why is he potentially making this bet, especially relative to U.S. markets? If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. So as usual, in full disclosure, this is not financial advice, and at the time of this video publication, I did own stock in the Alibaba, the Hong Kong shares in particular, which I bought through Interactive Brokers on the Hong Kong exchange once again. So look, despite all the news out of China, whether or not it's a real estate crisis with Evergrande, the property developers, the CCP regulators crushing the for-profit education sector, limiting the number of hours that kids and adults kids can play video games, fears of delisting the Chinese ADRs. I mean, there's just been an onslaught of bad news for these Chinese investments. Ray Dalio just still loves betting on China, and here it is. Bridgewater just announced that they have raised their third investment fund in China for the equivalent of $1.3 billion. It's a news story brought to you by Wall Street Journal, and talking about how their firm's prior bets on China have actually compounded at a pretty respectable rate in just the last few years, at 19% annualized over the last 3 years. Now, this follows their third quarter 21 update, which shows that Alibaba continues to remain a top 10 position, and that Bridgewater more than doubled their stake in Alibaba as the stock price continued to fall. So you could see how they increased. As the stock price fell, they more than 100% increased. They increased by 130% in terms of the number of shares that they bought. So that said, as a percentage of Bridgewater's portfolio, it's still only around 3% of their public markets portfolio. But now I'm going to call out an element that actually indicates that China is probably closer to a 10% bet of their portfolio. This is a massive bet that they're now making on China. And let me show you exactly what I mean, where their top three positions, which they dramatically increased, all in about 15% of their portfolio, are emerging market ETFs. This is a huge bet for them. You can see 15% of their portfolio, several billion dollars, over $3 billion that it looks like we're looking at here. So you could see how they increased one of these ETFs. They increased one of these ETFs, EEM, by over 800%. 18 million shares that So this is a huge increased bet that you saw in the third quarter. And when you look through these ETFs, it's apparent that this is another bet diversifying beyond the U.S., but also a huge bet on China as well, with each of these ETFs, China being one of the top positions, 30% of the funds each, while also providing exposure to countries like Taiwan, India, South Korea, and Brazil. But overall, look, 15% of the fund, and if you say, 30% of these ETFs each, that's another 5% of their public markets portfolio going to China, in addition to this 3% bet with Alibaba. So quite significant, I'd say, for them. So why is Bridgewater making this massive bet on China? I think part of this is to diversify away from the U.S. dollar. Ray Dalio has historically said cash is trash, especially as the U.S. is going to be looking to, effectively inflate their way through, high debt burdens and just more broadly, irresponsible, fiscal behavior. And we've certainly seen that with inflation ticking up in the U.S. And despite the fact that while the U.S. dollar has actually rallied fairly significantly in just the last few months, China's RMB, or the Chinese yuan, that has been surprisingly stronger. I mean, you can see how one US dollar now buys fewer Chinese RMB than at the start of this year. This currency appreciation should give China more flexibility to print money in response to any debt or real estate crisis they face. It's really important to consider that sort of flexibility. It might also be, from the fact, why else is Ray Dalio considering, or why is Bridgewater considering buying these ETFs, making this big bet on emerging markets, is that they trade at historically cheap multiples relative to the U.S. And in contrast, the U.S. indices trade at valuations that are literally several multiples higher than their prior lows. You can see how this S&P 500 price to sales ratio, is currently around over 3 times, previously bottomed out in 2009, closer to under 1 times, bottomed out in 2002, 2003, closer to around 1.2 times. So you're looking at multiples higher than their prior lows, something to consider. John Hussman has also done a great job showing the data points of historic correlations between price revenue ratios, so price to revenue ratios, and subsequent total returns. And he shows how for the S&P 500 from 1990 through 2021, the higher the ratio, the lower the 10-year return. This is concerning as this same chart, you can see it's a fairly straightforward correlation. The higher that price to revenue ratio over this multi-decade period did show, your lower subsequent actual returns. The lower the ratio, the higher the return. This makes sense. The lower the valuation, the more compelling something is. So he collected these data points, showing, hey, over the next 10 years, what did this look like? And so looking at this, and he's actually gone back even further to show that this correlation continues to remain very strong. This is very concerning because, it's effectively pointing out the fact that the U.S. indices, particularly the S&P 500, NASDAQ as well, is effectively facing negative 10-year returns, going forward is what you're likely looking at. And in contrast, while the U.S. indices or these valuations for the U.S. indices are in record territory, look at something like Alibaba, which, I still own. It's part of my Chinese basket that I own. It's making a record low price to sales valuation. You see, look, this business is still growing, and they're just price to sales just continues to drop. This valuation multiple is just getting so dramatically compressed. Now, part of it's warranted. I did a previous video on, Alibaba's third quarter results, and look, it's not great. Part of this multiple contraction is definitely warranted, but maybe, going from, 20 times sales to 2 times sales, maybe that's overdoing it. And, I leave that for you to call out. In my prior videos, I have called out why I think, Alibaba does still have, significant upside, even if their, fundamentals have deteriorated. Okay, so what am I doing here? And once again, if you enjoy, videos like this, please make a point of hitting that subscribe button, hit that thumbs up button. So personally, as I'm looking at this, there's a couple of things. So one, I still have my basket of Chinese stocks, which is about 15% of my personal portfolio. It's spread across a couple of things. Alibaba is not the largest position. It's spread across a few things, one of which is a company that trades well below liquidation value. And so, I've got my bets spread across a few different things that I think can work out in China. About 15% of my portfolio, and my view is just check on it quarterly, see what the quarterly updates are looking like. What do the fundamentals show? Because try not to get scared by the daily news that you're going to see. And look, this is not an all-in bet on China. Personally, this is saying, hey, this is 15% of my portfolio, recognizing that here it is, you have folks like Ray Dalio, major hedge fund managers saying, look, we're making these huge multi-billion-dollar bets on China as well as emerging markets around the world, partly because the valuations are much more compelling than the U.S. indices. So that is something that I'm considering. So I do, I'm keeping that basket. The next key component that I'm considering is that I really want to be deliberate, very deliberate with everything I own. And so this is where I sort of stratify, my portfolio. I have aspects of it where I'm looking for quality that's cheap, really cheap. I've called out, insurance company that trades at meaningful discount to book value, like 30% discount to book value, that's crushed the market indices for several decades. So I like owning that. I think there's a good chance it can keep happening. I'm looking at, companies that trade at like 10 times free cash flow, and they're returning lots of cash to shareholders. So I like seeing something like that, 10 times free cash flow growing at 10%. That gets me excited. Yet I'll also want to own hyper growth businesses that, might be growing 100, 200%, might trade at a very, like 20 times sales, but I'm sort of banking on management. Hey, if you can execute and continue to grow 100%, there's that potential for significant upside. I have called out, so not only do I own Alibaba, I have called out Facebook as well, which is a company that, in all honesty, doesn't strike me as crazy expensive. A lot will depend on the economy for that one, partly because, 95% plus of their business is ad revenue. But here, that's a company, I did a whole video on Facebook, which you can check out as well if you're interested. But Facebook, here it is, trades at effectively a teens multiple, high teens multiple, backing out their cash, factoring in what you expect them to grow. So if things don't, if let's say the ad revenue market doesn't completely shut down and people just don't stop using Facebook, that is sort of an example that I'm considering is sort of balance between this quality at crazy cheap as well as the hyper growth. Here it is, you sort of have Facebook in between. So I'm looking at all these different things. Want to be super deliberate about what I own. What are the risks I'm considering? In this market environment, a lot of folks have seen in just the last few days as growth stocks have gotten hammered. The last few weeks, several growth stocks down like 50% plus, is that they've realized that these companies that are valued based on margins that they're nowhere near delivering. These companies are hugely unprofitable, but they're being valued on margins that maybe they get in 10 years from now. That is going to be subject to a lot of changes in sentiment, and it'll be also changes in the balance sheet. Some of these companies might need to raise additional capital in the future to deal with the fact that they're unprofitable. So you're going to see more volatility for those types of companies. So that's a key aspect for when I look at my own portfolio. I want to think about, if you want more detail on my own personal portfolio, what am I doing? Go to unraveledinvesting.com, click join the journey. I have a weekly update. We also have an exclusive community on Discord where I interact on a daily basis. Also, by the last week of each month, I try to call out a potential multi-bagger. I just called out a company exclusively to my Journey subscribers, a company that I think has 600% upside that I recently bought for myself. And so, if you want more greater detail on my own personal journey at unraveledinvesting.com. Otherwise, if you enjoy videos like this, diving into headlines like what's Ray Dalio doing, and holy smokes, he just more than doubled his bet on Alibaba, dramatically increasing his bet on China, please make a point of hitting that subscribe and hit that thumbs up button. Thanks so much for watching.